Okay, now we're recording 2 minutes in. So this week we're giving back some of that ground I was saying, and it feels more rational to me because I don't think that this can be just a rocket ship up, like everything's all better again. And to me, it kind of felt that way after last week. Hi, Gary. Hi, Tracy. It's kind of cool to see faces pop up. So last week, actually the last 2 weeks in this call, one of the things that we talked about was that I don't think this is likely to be what people are calling a V-shaped recovery, where you just, plummet down and plummet back up. I think that we've got to bump along for a while. And I think that, let's see. So I think that that's starting to play out over the last couple of weeks, that it's going to be up and down, and we've got a lot of news to digest. So one of the things that we talked about last week is that the news coming out this week, next week, probably the week after that, it's going to be ugly. We had a lot of good news really fast in March. We had all of the we had all of the monetary stimulus plans from the government. We had the fiscal stimulus plan, and we started to see the light at the end of the tunnel in terms of increasing virus data. At this point, it does look like virus data or virus cases in the US have plateaued. And so we're starting to look past that. As we look past that and start to focus on other things, what we're going to get for the next few weeks is probably a lot of earnings data from companies reporting earnings, and maybe more economic data. And that is going to be ugly and maybe shockingly ugly. And this is one of the things we've talked about. It'll be shockingly bad, but it won't be surprising. It's what we're expecting. So with that, I think that the market's going to need to see this and digest it. We think that there's an obviousness of no real plan or line of sight right now to reopening the economy. Yes, there's a discussion happening. I know the governors of New York, New Jersey, Connecticut, Rhode Island, Delaware, maybe Massachusetts, they're getting together and they're starting to coordinate and starting to talk about how to reopen. Those conversations are early, and I think it's going to take time. And I think that there could be confusion and disappointment, and it could be a bumpy path as we start to recover. So we need to be able to see that. Let's see. What I'm trying to make sure that I don't get too off track with my meandering thoughts. So maybe from there, I'm going to jump into my portfolio, the equity income portfolio. Greg will touch on the growth portfolio and the international portfolio, and then we'll get into new news since last week. And to be honest, there's not a lot of new news since last week. So in our portfolio, there's been some good news and some bad news over the last week. I'll give you the bad news first. Covanta is a company that trimmed their dividend last night, and that was really disappointing. They trimmed it by about 60%, and that was a surprise to us, and a disappointing surprise. In fact, yesterday morning, Stifel, who does excellent research, came out with a report not only recommending the company, but reaffirming the safety and the wherewithal to support the dividend. Just last week, Goldman Sachs also had a report out with a $10 price target. We've spoken to the management multiple times, and as recently as 12 days ago, and also believed the dividend to be quite secure and safe. So this was a big disappointment. We will get out of this, and we will get out of this one relatively quickly. In better news, there's actually a reasonable amount of better news in the portfolio. It's all a little small, tangential, but it's positive. Dow, for example, has significantly expanded their manufacturing of hand sanitizer at plants in the US, Belgium, and Brazil. That's a big deal. IBM's been out there publicly saying that they're helping states out with their technology needs. GM started to roll out the first ventilators. Hannon Armstrong has increased their liquidity. Pfizer has announced different things that they're working on to fight COVID-19. Tanger's one that we're getting out of, but there was a bit of positive news last week on that too, as they announced the replacement of their president and COO. And then Westrock, which is a company that we've talked about a lot, they're one of the ones that makes container board and packaging. So think about like when you buy a frozen food, the box that comes in, or a cereal box, that's a lot of what they make. They've actually said that that's positive and really good for their business, which is something that we've been expecting. So there is positive in the portfolio in addition to the negatives. With respect to transactions and movements in the portfolio, we are continuing to work our way out of Ford. Ford, Six Flags, and Ryman, those are the ones that are going in very short order, followed by Targa, depending on energy price swings that we've seen that move the price. We've been being very opportunistic about trying to get out of Ford, and we're able to trim some of it yesterday. We're trying to take advantage of when the market bumps up. And as you know, these bumps up and bumps down are short-lived. So we're using price targets and limit orders and trying to sell very carefully and make the most of that. So that's really it in terms of updates for the portfolio over the past week. We have added one company to the research list, which is Broadcom, and that's going really well and is really interesting. That has a 5% yield and $100 million market cap. And in some ways is like Qualcomm that makes the chips for your phone, but they also do a lot more. So as we work on that, if it makes it into the portfolio and replaces some of the laggards, I will keep you updated on that. I'm going to turn it over to Greg right now to touch on changes in his, or sorry, no changes because there aren't any changes in the portfolio, but on just updates for his portfolios, for the growth portfolio and for the international portfolio. And then we'll get into news over the past week and then open it up for questions. So Greg.
Okay, I'll start on the international portfolio, which I'll start by highlighting Taiwan Semiconductor, because I think this is a great example of how not all companies are going to be immediately impacted by the virus. They just reported that their March sales were up 42%. Sales for the quarter were up 42%. They're doing quite well, and the semiconductor industry is still prospering, even though the virus has had an impact on many other industries around the world. We're still looking to sell Kingfisher. The Kingfisher is the home improvement retailer based in the UK and France. They had suspended their dividend last month. We're still looking to maximize the price we sell it at. But we did get good news on Total, where there's been some uncertainty in the energy sector whether companies will continue their dividend. They gave a trading update today, and it looks like they're going to be able to maintain their dividend and are even free cash flow positive, even with Brent crude in the $30 to $35 range. So that's a positive sign. Turning over to the growth portfolio, there's been not a lot of news, but there has been a tremendous amount of research that's been coming out by investment banks previewing the first quarter earnings. And there's been a lot of positive reports on our holdings. One of them, Aptiv, there's a new buy recommendation from Goldman Sachs. Aptiv, it's an auto parts company. They benefit from the electrification of vehicles and autonomous driving. Goldman really loves Aptiv and thinks they're going to be one of the biggest beneficiaries of these trends. There was a good report on Applied Materials from Deutsche Bank. They're highlighting how the 18% decline in the share price this year just doesn't reflect the current economic reality. The business is actually doing quite well. Also, Fiserv, there's a really good report from Baird. Very positive things to say about Fiserv and how they're continuing to do quite well despite the virus. And that's the big highlights from the growth and international portfolio so far in the past week.
Okay, do you want to touch on some news like about cases in the U.S. and Gilead and that kind of stuff?
Yeah, do you want me to touch on the news? So I think some of the biggest developments in the past week since we last spoke is just the overall the decline in the number of new cases of the virus, especially in the U.S. It appears that the number of new cases in the virus have peaked and have been coming down very slowly over the past week. We still need more data to confirm this, but it's also supplemented by reports that hospitalizations in New York State, which is the hardest hit area of the United States, have been coming down. So there's overall some pretty good data out of the U.S. In Europe, number of cases continue to come down. Germany, has had a clear peak. New cases in Germany are down about 70%. News just hit across that they're looking to Angela Merkel is looking to reopen the German economy, start reopening the economy very soon. Italy, cases are down over 50%. The data continues to improve from Italy. So overall, in terms of the virus spread, it's clear that social distancing is working. Number of cases are falling in most parts of the world. We did have some good positive data on a potential treatment for the virus from Gilead, who their drug remdesivir, which was I believe it was originally a a treatment for Ebola, which they've applied to the coronavirus. Now, this is not a formal study, but they did in a compassionate care use case. They most of the patients receiving it did show a meaningful improvement. Now, this was given to some of the sickest patients, people on ventilators, pretty much near death, and many of them had improved, and many of them were discharged. It's not a full study. We've got to wait another couple of weeks till we get official studies out, but it is a positive piece of news that the treatments can work, and they're not the only ones working on one. There's other companies working on this as well, but that was encouraging to see.
Right.
As far as on the economic front, obviously the big headlines today were on retail sales, which were down 8.7%. As we keep saying, this is shocking, but certainly not surprising. And it does give a little clarity of just how much sales are being impacted from the virus. We did have, there's no real news on the policy front. The Fed continues to buy, although their purchases of assets have slowed in the last week. We've seen their last week, they had been buying about $500 billion of assets per week. This week it slowed to just under $300 billion. We think that's overall, that's good news, and that while we do, the market is certainly, seems to perform better when the Fed is buying. I mean, I think it does point to a more sustainable move up in the markets if the Fed is less involved in the rally. So there is some positives to that. I believe that's. Did I miss any points, Jenny?
No, you know what? But there was one thing that I wanted to mention that I forgot earlier in the call, which is just a little perspective on the market. So the market, as of just about now, the S&P 500 was down about 14%. And I think that it's important for us to remember that that's not a great indicator of the broader market or what's really going on out there. And I think that's something that's kind of been bothering and unnerving me, is to say, oh, but the market's rallied up so much, it's only down 14% on the year. It's not the right way to look at it, because it's 500 companies that are disproportionately weighted because of the market cap weighting nature of that index. It's disproportionately weighted to a handful of very, very large, very frankly expensive companies like Amazon, Apple, Microsoft, Google, Netflix. But just to give perspective on that, the Russell 2000 is a widely used benchmark also, and that's 2,000 companies, and it's a much broader representation of the economy. I think it's also a broader representation because it involves small companies, which, even non-publicly traded, or rather not even, but we all know that non-publicly traded companies, like all the restaurants and all the stores in our towns, are probably more representative of what's going on out there. So just to give you perspective, that index, the Russell 2000, is down 29% right now. And I think that that's probably a more accurate way to think about what's going on with the recovery, what's going on with the real market, what's going on with most companies out there. So just a little perspective on that. As a complete aside, well, not complete, but as a little bit of an aside from that, there's a S&P 500 high dividend index that people use. It's an exchange traded fund, and that's down 34% on the year. So I think maybe as we feel a disconnect between the market and what we see and hear out there, remember that the S&P might not be the best way to look at the market, and maybe we look at the Russell 2000 or 3000. That's about it. So I think from there, I'd like to open it up to questions. Like last week, please email me or please unmute yourself, and don't hesitate to ask questions. I'll just remind you all that everyone's portfolios are, some people have one strategy, some people have another, some people bought it one time, some people bought it cash. So if you have specific to your portfolio questions, please don't hesitate to ask me those directly. And then if you have questions here that are kind of broader, more for the group, please ask them. I know that everyone enjoys hearing other people's questions, so please don't be shy to ask them. Okay, that's it. Should I I think we're good enough at this. I'll let people unmute themselves. And here, let me just check my emails to see if anyone's emailed me. But I'll let you unmute yourselves if you have questions. So *6 if you're on the phone, or just click on the little, microphone tab on your thing. No, I have no email questions this week, whereas I had lots last week. Anyone got anything for me? I can manufacture them. You want me to manufacture some questions?
Hey,
Oh, hi.
hey, Jen.
Hi, Tracy.
So I'm a little confused about Covanta. I thought you just bought some of that yesterday.
Yeah, so here's what happened. So yesterday we started to trim forward, and then we were starting to add 3 positions. So we started adding Navient, Compass Diversified, and Covanta. We were using limits on all of those. So some of the Covanta in your account it executed and others it didn't. So Navient executed for everyone, Six Flags executed for no one. I'm sorry, I did not mean to say Six Flags. What is wrong with me? Compass Diversified executed for no one because the limit was lower, and some of the Covanta executed and some didn't. So it was really disappointing and really disheartening when I saw that last night, especially after me speaking to them. Literally 12 days ago, I spoke to them again and reconfirmed everything and reread the email after that saying, nothing's wrong, we're fine. This is the cash that we have. This is our EBITDA. It can support this. After rereading Goldman's report and reading Stifel's report. So that was really, really disappointing. So yes, for some we added, but for
So
others.
are you going to sell it now?
Yeah, we're going to sell it.
Okay, because I don't think
we're just going to take the lump on that and
Yeah.
repurpose.
And I guess my other question is, given these huge ups and downs with the market as a whole, and it has nothing to do with particular stocks that you're buying.
Yeah.
Are you thinking, given what's going on with this very uncertain territory, that as you're selling the stocks you want to get rid of, that you're just going to be holding some more cash for us, as opposed to immediately reinvesting in other stuff? Or kind of what's your strategy here?
That's such a perfect and on-point question. So this is the challenge of that, which is these moves are severe. And when I look at things from the individual company level, I can go in and I hope mostly get it right. Covanta I got wrong, but I think I'm getting it right on Compass, and I think I'll get it right on Broadcom, and I think I'll get it right on Navient. But we can use limits. And so yesterday, for example, I had limits on the sales, I had limits on the buys, and trying to say at what price does this make sense. But I think the bigger question on holding cash is, I do not intend for fully invested portfolios. And this is different, in your case, Tracy, it's different too, because you have an allocated portfolio, an asset allocated portfolio, whereas some people hire me just for this strategy. But by and large, I think that we should not be holding a lot of cash right now. And the reason for that is because what I know from years of market history and years of being a professional investor is that if I miss the 40 best days over a 10-year period, and Greg just did this study and I'm happy to send it around, but if you missed the 10 best days over the last 10 years, let's say you'd invested $1 million at the end of 2009, and then fast forwarded to the end of 2019, so 10 years. $1 million fully invested through that whole time, which had really nasty pullbacks in it, would be worth about $3.5 million. If I had missed the 40 best days in that period, that $1 million would be worth $909,000, or maybe it's $905,000. That's a huge difference. Last week, for example, on April 6th, the market was up 7%. We were actually that day a little bit ahead of the market, which was nice. But my point of this is the following. If I miss 40 days like that, and I don't know when they're coming to me, it's all for naught. I might as well not be invested. So I feel like we all just need to grit our teeth and bear it and stay invested. And I think in this kind of environment where the market's moving really fast, I think holding cash could ultimately punish us. So I don't intend to hold cash for a significant period of time or a significant amount.
Okay, thank you.
You're welcome. Any other questions?
I got one for you, Jenny.
Let's hear it. Yeah.
Just kind of wondering if there would be a desire to have less stocks in the portfolio, considering it seems to be more difficult now than ever to pick people that are going to have growth and pick people that are going to be consistent on dividends. Would it ever make sense to have a smaller range of stocks in the portfolio?
Yeah, you're spot on, and that's what I've been working towards. So what you've seen a little bit of already is, we all know I'm selling Ford, Six Flags, Ryman, Targa, now Covanta. And the fact that I'm not reinvesting in new companies, but rather repurposing that into existing is part of that effort to consolidate the portfolio. The portfolio over the years, it always says it's 30 to 40 stocks. It's kind of ranged between 32 and 37. I'd be pretty happy to see it more in that 32 to 33 range, maybe even 31 to 32. I think that that's still a good number, well diversified, but I think it is tough. And so I don't think, if I lose 6 companies from this, I don't think we'll add more than 3 new ones. And maybe when we lose 7 and only add 3 new ones. So yeah, you're exactly right. I'd love to continue to consolidate it. Yeah, thanks. What other questions?
Oh, Jen, you talked a couple of weeks ago about 3M, which I think was gearing up to make some masks and whatever. Is that still on your radar or not?
It's still, the 4 potential new ones, they haven't changed too much. Other than that, they've gone from 3 to 4. Remain UPS, Cisco, 3M, and Broadcom, which has come more onto the research list, or we've researched it more in the past 2 weeks. So that's the short list now, but they need to be at the right price. And that's pretty tricky. So for example, when 3M hit the right price, I need to buy that under 120 to make it, I think, compelling and worth the risk reward trade-off. So that's still on there. It hit under 120 for all of like 15 seconds. Maybe it was 5 minutes, but it was a very short period of time. And that was on the morning of March 23rd when the market was really bottoming out. And at those points in time, I need to say to myself, okay, at this point, what's the opportunity cost of selling other things in the portfolio to buy 3M? So while 3M's moved up, it's up about 16 or 17% since then. What I held, what I would have needed to sell to buy it has moved up many, many multiples of 16 times. Some of these stocks are the things we've talked about in the last couple of weeks. They're up like 50 or 80 or 100% since that bottom. And that's the challenge, is the constant weighing of the opportunity cost of what we'll sell to get into something new.
I should mention, I don't know whether all of you live in areas of the country where this is happening, but I mean, UPS has been delivering up till 9:30 at night in Rhode Island.
Yeah.
So they are like really doing amazing stuff here.
Yeah, it's pretty crazy to see. So in front of my office, I'd say the UPS truck pulls up. There's not even anyone else in the building. There's only one other company that's still coming into the building. And UPS pulls up at least 2 or 3 times a day, as does FedEx. So and they're constantly just passing by the window. I know they're delivering a ton. And I think they're probably picking up business from Amazon too, who has said that I think going forward, they're going to start to back off of that kind of delivery service for individual companies. So it would be nice to get in on that. But again, it has to be at the right price. And it has to be with the right opportunity cost of what I'm selling to replace it. Who else has questions?
What is the right price for UPS that you're concerned about?
I think under $85 a share, maybe 82, is about where I'd like to own it. I think at that price, I've got the right mix of upside potential, of yield, and of valuation.
Okay.
Yeah.
And what is it running now?
Right now, I think it's about 97. It might have actually broken over 100. Hold on.
Oh, okay.
Yeah. So, but I'm not entirely sure that we won't see these prices. I think we're going to get, sorry. Why won't this pull up?
Was 82 a March price?
I think that was right around that March 23rd low also. Yes, at 99 now. So I think we might see some ugly days. I think one of the interesting things now versus 2018, in the move in 2018, where we were down 20% from peak to trough also, that was slower. That took place over 3 months. But there was more, I felt like there was more dislocation of higher quality companies, whereas in this, there's been a huge bifurcation. So you could think of AT&T and Verizon, for example. AT&T is down probably close to 25%. Verizon's not down much at all. And the primary differentiator there is leverage. AT&T has more leverage than Verizon. Forget the fact that they're probably going to fare better from a revenue and earnings standpoint through this environment. But the share prices are just bifurcated on things like leverage, on something like leverage. And I know that there have been algorithmic trading programs out there that identify and just sell off companies that have more leverage than those that don't. So I've seen that where, I've seen it work in both directions, and on companies like UPS, 3M, they've held up really, really well. Or you could take the Broadcom and Qualcomm, for example. Qualcomm's held up a little bit better, not too much, a little bit better than Broadcom. Broadcom has more leverage than Qualcomm. I would argue in the case of Broadcom versus Qualcomm that Broadcom should fare better from a revenues perspective in the next couple of years because they have a more diversified stream of revenues. So that's why that's really increasingly compelling to me as a potential new investment.
Right.
All right, who else has something for me?
Is there a reason that we don't get to see Greg's pretty face? Is he shy or?
I will accept that as a challenge on his behalf for him to show up in person next week.
The problem with my video feed is that I'm sharing my house with 3 kids who are Zoom conferencing as well for school, a wife who's trying to teach through Zoom. So my the video and audio quality is not great through the computer. That's my excuse. And I haven't shaven in about 5 days.
Are you really sure you're not sitting there in your pajamas?
Wow, I didn't say that.
That's funny.
Go, Greg. All right.
You could put a fake background in, Greg, make it look like you're on vacation somewhere.
Jenny, what is your target price on Cisco?
That one I'd love to buy below 35.
Well, it's 31 right now, isn't it?
Cisco? No, it's 41.
Oh, it's 41?
Yeah, maybe it was 42 this morning, so I'm assuming it's 41 now.
Okay.
Don't worry, George, I am on it. The minute that sucker gets in my range, I'm gonna grab it.
I could have sworn it's just saw it go back, but
No,
Hey,
not.
I'm sure you're right.
As long as you're looking at this, when I started at Goldman Sachs, they would train us, right? And they would train us on all sorts of different things. And one of the trainings was a trading thing. So they'd pretend to be a client. They'd call them and they go, hey, buy me 10,000 shares of Cisco, quick. And then you'd hang up the phone and you'd put a mock order in. And then you'd call the client back with the report and you'd say, I just bought your Cisco CSCO at, $25 a share. And then the client would say, CSCO, I meant Cisco SYY. That was always one of the traps or tricks there. So maybe SYY is trading at 31, but I don't know. That's not one.
Cisco's at 41.77 right now.
Okay.
Yeah.
There you go.
I just backed up the tape to look. Yeah.
Yeah.
Sorry about that.
It's all right. Okay, who else has questions? Anyone?
I have a question. What about CVS? Is that on your radar at all?
No, it's not. It's on the screen, but it's not something that I'm working on. I think CVS probably has retail pressure. One of the interesting things I heard in a call last week was that what this environment is doing is that it's accelerating the demise of bricks and mortar retail by 5 years. And I think that's really interesting, and it's really proving out. I mean, I know that we've done the vast majority of our shopping for everything, including drugstore products online, and had it all delivered, more so even than we do normally. So I think I think that there's too much risk there. And I think I've talked about this in the past, but last summer, we did a huge, deep dive into retail because all the retail companies were showing up on our screen with, multiples of 10 times or less and dividend yields of 6, 7, 8 times. And it looked like there should be something really compelling there. And we spent tons of time. We spoke to retail experts. We went to conferences. We spoke amongst ourselves. We read everything we could. And there wasn't anything that was viable where Greg and Andrew and I could all get to the point where we had clarity of vision into the future, where we could really see how a Nordstrom or a Kohl's or Macy's survived, or Gap stores survived into the future. And CVS, frankly, fits that bill a little. I think CVS has more insulation, but there's not a super clear path there on why they should flourish. You know, yeah, they'll survive, but why should they flourish? And I couldn't come up with that thesis.
Well, aren't they involved with Anthem now? They own Anthem. Is it correct? Is it Anthem?
Greg, do you know that? I haven't researched it.
I believe so. Yes, that's the one they bought. Yeah, it's become a much more complicated business than
Yeah.
just a simple pharmacy retailer.
Yeah.
What about some of the grocery store chains?
So those don't have high enough dividend yields or for the equity income portfolio, and they don't have high enough free cash flow or margins for the disciplined growth strategy. So they don't really make the cut. I think one of the things that could be interesting coming out of this wouldn't be so much the grocery store chains, but could be the grocery anchored strip mall REITs. So for example, there's a company called Kimco, and they have really, really high quality strip centers that are anchored by grocery stores. And so that could be interesting because it's trading as if, you know, it's never going to exist again. But we know that groceries are important. The thing is, in those strip centers, there's, you know, the pizza store and the nail parlor, and those guys are totally out of business now. So that could be one where in the future, opportunities have been created to invest in that company because of this. But I don't think, and I don't, Greg, you agree, right, on the grocery stores? Do you have any differing opinion there?
No, I think that there's not a lot of yield there, and they're a necessity. It's just I think depends on how we get our groceries. There may be more opportunities for delivery, but I think you're right. The shopping centers are going to still be there.
Mm-hmm. The margins, that when you look at the grocery store companies, the margins they make you want to cry. You just feel sorry for anyone trying to operate in that space.
Jenny, what's going to happen to Macy's and all these malls?
George, I keep telling you, this is only in your portfolio.
I know.
It's a legacy position. No, I think on Macy's, so I think, you know, I go back to that comment, which is I think that the demise of a lot of the bricks and retail, I think the demise will be sped up by 5 years. I think Macy's is unique in this, in that they have tremendous real estate assets. And so once this shakes out, maybe they do sell to a distressed fund, or maybe they sell off, you know, or close down, I don't know, their retail operations and just consider themselves a real estate company. So Macy's is different in that because of those assets than I think a Kohl's or a Gap. I'll keep Nordstrom out of that mix because they have such tremendous, I think it's 34% family owned still. And I think that they have the wherewithal to ultimately go private and take themselves private. So that'll be different. But it's shifting. We had apparently the last mall in America was built in our town of Norwalk, where we live. And it was actually, it should have been a successful mall. It's right, you know, it's right on I-95. It's 25 miles from one mall and 25 miles or 15 miles or something from the other mall. And it was really, really high quality. And we were just talking about this the other day, how tragic it is, because that actually should have been one that survived. And all the fancy stores, Bloomingdale's went in and Nordstrom's went in, and they put in these flagship, beautiful, beautiful properties. And I don't know how that mall fares coming out of this. You know, maybe this is too much for them. By the way, Macy's owns Bloomingdale's. Okay. Any other questions? Okay, well, you all know where to reach me, and you know what I'm doing all day, every day. We're getting through this one step at a time. As one of you told me last week, I have a steep hill to climb, and I'm super aware of that. And I think it's steep, and I think it's hard, and it's daunting, but I think it's absolutely achievable. We sent out our quarterly letter this week, which was dense and hard. And I think in writing that, to me, the most important part was where I said, you know, reflecting on everything that we know, I think it's easy to be optimistic for the long run. And I think that's true. I think the one thing I know for sure is that 2021 will be better than 2020. And as 2021 becomes more clear and more visible, we'll continue marching towards that. So this is tough and really hard and pretty miserable. I know I have a cheery face and a cheery voice, but please don't mistake that for me feeling quite miserable on the inside. But it's achievable, and we'll get through this. So, oh, one last thing. If I said this already last week, I apologize for being repetitive. But I was speaking to one of the advisors that I work with in Bryn Mawr last week, this really great guy, and he's a real market historian. And he said, you know, this may not be the exact way this was said, but I was at a conference, you know, in the 1970s or something, maybe the 1980s, with Peter Lynch, who was a famous, really incredible portfolio manager, some of the best returns ever. And he said, someone raised their hand and said, Mr. Lynch, could you please tell us your secret to successfully investing in the market for as long and as well as you've had? And he said, oh, it's easy. You need to stay invested in the market. So I'm channeling my inner Peter Lynch through this, channeling all my market data of what happens if I miss that April 6th day too many times. So we'll get through this. And even with Covanta, the income is by and large intact and will be replaced where we have misses like that. And I think we'll come out of this with the income in pretty good shape. So thank you so much.
One last question.
Okay, let's hear it.
All right. I think personally, this is not, you know me, I'm a very negative person. Well, no.
Well, I love you, George.
I think that this is going to be an opportunity for management to cut dividends across the board, so they can, you know, sustain their cash flow. That's my personal opinion. It's almost like everybody's, hey,
Yeah.
we have an opportunity right now to cut our dividend or lower it or eliminate it, whatever the case might be, to put ourselves in a better situation for the future.
Well, on
Which-
that cheery note, should have asked that earlier. So I think in some cases you might be right. And we have, you know, I think that'll be true again for companies where they don't have a philosophical and well, I don't know what the right words are right now, but a well telegraphed message that says to shareholders, our number one goal is to protect the dividend. And that is how we provide return for you. So maybe there are companies where the dividend was secondary, you know, and it was like a cherry on top and blah, blah, blah. That's probably true for some of those companies. For many of the companies in our portfolio, they know that the reason they have shareholders is because of the dividend, because these are mature, cash flow oriented, not necessarily high growth companies. And all they have to entice shareholders to remain shareholders is the dividend. So companies like Dow, for example, publicly state, they say the sole goal or the number one focus of the board is the dividend, right? There are a lot of companies like that, and that's how they maintain their shareholder base. So I think you might be right for companies where it's a frivolous or an aside, but a lot of the companies that we own in our portfolio know that they will lose half to 75% of their shareholder base if they disrupt that dividend, because that is the return that they give to their shareholders. So I think for our portfolio, that the frivolity of the ability to do that doesn't come into play. For something like Covanta, for example, that's a serious decision that they made. That is not a decision that they made that said like, oh, we can take a hall pass on this, everyone's doing it. That's a company that's backed by Sam Zell, who's the chairman of their board, who's a unbelievably successful investor, most in real estate. He put together and packaged this company. When I met with them at their headquarters, the conversation was, when we created this dividend, the conversation with Sam Zell was, if you put a dividend in place, you better be able to defend it through anything. And here's why. So I know that when they cut, like, it is a very serious, very hard decision to make. So I think for what we own, I'm not sure that's true. I think for what we own, the vast majority will stick with it.
So in terms of,
Anyone else got any cheeriness to end this call with? No? Okay. Don't hesitate to call or email. I can't thank you all enough for participating. We'll see you next week unless there's nothing to talk about. And if there's nothing to talk about, maybe we'll take a pass on next week. But there's probably going to be stuff to talk about. So we'll let you know on Monday. But at this point, I'd say plan on doing a call next Wednesday. Thank you all. Don't hesitate to call, and I'll talk to you and see you soon.
Bye, Jim.